welcome to this webinar. Uh, I guess this time the budget happened on a weekend and I think we just passed it through. Okay, so let us spend some time and look at what are the various, points that one need to keep in mind, how the budget is helping us, etc. But this time the budget, was in an environment where you had a lot of market volatility, right? And especially uh, if you see the small caps, have corrected that much more. Of course, this is the first row is, talking about the drawdown. And basically, drawdown fall from the peak to date. Okay. Typically, we also look at it from peak to low. If you look at it from peak to low, even the Nifty and the mid cap indices would have fallen more. But what is shown as Nifty SC is small cap, and MC is basically the mid cap out here. And while the large cap, which is Nifty 50, and the mid cap indices have come back to their almost close to their peaks or within 3% of their peaks, uh, the small cap is still down 14.5% from its peak. Okay, so that says it all. What that also results in is that the peak P that you look at, right, which is was 24.4 is for the Nifty has come down to 22.1, and similarly, there's been a very steep fall in the P of the mid cap, which is 45 times to 32 times of earnings. And similarly, small cap has come down from 35 to 26. Now, what you may normally find is that typically the small cap could end up being, the highest P because typically you see the highest, earnings growth also there, and which is why normally you see it the highest. But there are periods like now where, the small cap has corrected more and it has come down. It's coming almost closer to the P of the Nifty 50, okay, which is very interesting because that indicates that the valuations are, at a good place. Now, you can see that the uh, TTM is trailing 12 months EPS is earnings per share growth. Okay, of the Nifty was up, say, 4.9%. And similarly, if you looked at for the mid cap indices was up, 26%. And the small cap was, up about 15.6. Yes, it's not very normal that you find the earnings growth of the small cap index, a lot lower. But we saw a situation where, from, 24 December onwards, we saw pressure on earnings, which also is why the small cap index started correcting. But we will also go back to the last quarter as we go on in the presentation and see how it is done. So in summary, basically valuations have compressed in mid and small caps on the back of strong earnings growth. And so what has resulted in the valuation fall or valuation discount from its peak, right? Is that earnings has grown, right? So when earnings grow, basically, then accordingly, the denominator sort of because it's priced by earnings. So if earnings grows faster, then your P ratio comes down, right? So that is what has helped the P ratio come down. You can see from the mid cap index, it's almost flattish in terms of fall from the peak. So it is not price fall as much as the growth in earnings, which you can see both for mid cap and small cap. The earnings growth has been reasonably good, and I think markets has its own way of uh, being able to estimate or predict, right? And this is a classic example to see that if you see earnings growth in this period for mid caps has been higher, and which is also why the fall, in mid caps has been much lesser than small caps, right? So that is something that, time and again, market has proven us that the basic earnings uh, growth and stuff like that, you'll see it later when the market is able to predict it a little earlier, right? So this is something that what is created volatility and why have we seen some of this volatility out there? So, so this volatility uh, has been primarily on, I think on Trump has been the biggest reason. Okay, there's been a lot of uncertainty out there. There, there were counter taxes which were posed on India, and those tariffs, had a big sentimental impact as well. There were also FPI outflows, and this has also resulted in weakness out there. And what has not helped is weakness in the rupee. And so when foreign investors invest in India, and the rupee weakens, you will find that they see further erosion, in their portfolio value because of the INR weakness. So, so that so even if returns are uh, have been negative, then the INR weakness would have even made it much worse, in terms of the impact of that. And so that's something that has kept markets volatile. And of course, in the recent time, the budget day as well, and this security transaction tax over the last couple of days that saw some volatility. But I think the bigger one has been around, Trump tariffs and the FPIs. And I think the other reason is just that, Indian markets did very, very well for a period of time. So up to 24, the markets did very well. So it's normal to see, and it's actually healthy to see a correction. And the good part was the correction has been not as large as some of the larger falls that have happened in the past. But what we've seen significantly is a time correction, right? Which is like for mid caps, etc. While earnings have grown so much, okay, the prices have been slightly lower than where they were, sometime back from the peak of say September 24. Okay, and we almost are seeing like a 15, 16 month type of time correction, where markets are where they were, but earnings have gone up very, very strong. Right. So that has been sort of the reason for some bit of the volatility. And so we come back to the budget. Okay. And while one is in the budget, I just wanted to poll. Okay. What, as per you, is the likely impact of this budget on your portfolio? Do you think it's going to be positive, negative, or neutral? Yeah, Tara can, yeah, has the poll running. So if you can poll, okay, then we'll get a bit of a sentiment for all of us. So we'll give a few more seconds to people to be able to vote. Yes, so it's interesting, almost 57% of us have polled basically, I'll end the poll first, yeah. So about 50% have polled that, they don't expect any change. Okay, it's neutral. About 38% are positive, and about 12% negative. So, so what is interesting is that most of us feel that budget is non-event. Okay, and some of us, a good number of us, also feel that the budget will have a positive impact. Okay, so I will come back and share a little bit more perspective of my own views. Okay, as we go forward. Yeah. So basically, coming to the impact on the personal finance side, basically, if you look at what are the announcements that were there which are relevant to personal finance, or ones which can impact on certain assets and or your income, etc. Uh, First of all, there's been no change in personal income tax slabs. Okay, so that has been neutral. Okay, which is why I guess many of us have said that this budget is a non-event, at least on the personal finance. For a good part of it. it has been reasonably where it was. What is some of the benefits that have come in there? I think one is on the buybacks. Earlier, there was a change that happened, and buyback tax, was applied, which was differential from this capital gains tax. Okay, and this resulted in, a huge impact if anyone participated in buybacks. Okay, I think that is now changed, and we are moving back to, buybacks being coming in as capital gains rather than at a slab rate. This can be very have a very large impact for, let's say, investors who are in, or or even employees who have ESOPs and say Wipro and Infosys, etc., and TCS, which have reasonably large buybacks in the past. And what would have meant is, if you sold through the buyback route instead of sold in the market, okay, it would have got added to income, which, so, and for some of us it may go right up to, with all the higher surcharge slabs based on your income levels, it could have gone all the way up to 42%. So versus having, say, a long-term capital gains of 12 and a half or 20% in the short term. So that's a big benefit out there. uh, Other than that, some of it is more on simplification. The new Income Tax Act 2025 will become effective from 1st April of 26. Okay, what it tries to do is simplify, lower litigation, and makes life a little bit more simpler for us. Of course, on the negative side, it takes away some of the exemptions. I think one of it, which was, a lot to do with home loans and the tax benefits that many of us have got in the past. Okay, some of those, go away under the new, tax regime. So that is something which we may miss out on some of the deductions, in the new Income Tax Act. Okay, but what it does is, of course, it simplifies. But because the government gave in, entry slabs, etc., to, pass on the benefit, to that extent, it may not have too much of a negative impact out there. Okay, because under that regime, when you don't have the deductions, you also end up having lower taxes specifically for those who go through that regime, right? So the TCS is sort of reduced to 2% for overseas tours. There was some crazy increase that happened, in terms of TCS when you transfer money overseas. Okay, and so this is for education, medical, and for overseas tours. That has been sort of uh, reduced. Okay, and other than that, points like creating a framework for corporate bond market, which basically market making framework, and it sort of tries to improve liquidity for bonds. I think that's a welcome move because I think the bond market is not as deep as the equity market. Then there are a lot of revamp of the FEMA framework, foreign exchange management rules that you have. Okay, so and those easing of it will make life a lot easier. The ease of doing business is not necessarily the best in India, and so some of these measures are will help improve the ease of doing business in India. Of course, the big negative for investors who invest in futures and options, okay, there has been an increase from zero point zero 0.02 to 0.05 for futures and zero point 0.1 to 0.15 for options. Okay, for most of long-term investors, there's no impact because one doesn't deal in futures and options. But for some of us who do, and active traders and day traders, etc., who use or invest into futures and options, I think this is going to be an impact for them. Okay, so other than that, if you go back and see the economic impact of the budget as a whole, yes, actually, there is an impact. What is the impact? A good part of it is, there are other points of how the government is spending money. How is the government maintaining fiscal discipline, right? And we will also see how it is relative to other global countries out there. So we continue to we are one of the countries which have been very disciplined and working on fiscal discipline in a very systematic way. And I think this is really good. And why is it good for us? It is good because otherwise you may find that it may trigger interest rates, borrowing costs will go up, etc. Uh, and it will increase inflation for us. Okay, in our daily spends. So maintaining fiscal discipline, is very good, at a government level, and it's good for the country in the long term. The second is about, there's a good amount of spending on capex and various sectors. I think that for investors and who have exposure to either equity mutual funds or stocks or any other route through AIFs, okay, or even direct stocks if some of us have, okay, then various sectors benefit from the big infrastructure push, and infrastructure push also is good for India because what it does, it has a much larger impact because, for example, if there's a push on, say, roads, it creates employment, then a lot of building materials, etc., and infrastructure, the materials required for that, okay, all get a fillip, right? So it has a good multiplier impact on the economy. So I think, and public capex, you will find that countries which have very good, public infrastructure also have done very, very well. Okay, so that is something which sort of, will help, investors, and it will also give an impetus to the stock market. And I think that this is a big, positive there. Yeah, on the negative side, you have the STT, which sort of is going to be impacting for futures and options. Yes, it will have some marginal impact for the new category, which is SIF. Apart from mutual funds, now the new category, which is there, is an SIF, and they are allowed to, hedge the portfolios, etc. So that will have some, marginal, impact on returns, but it is going to be very, very small for the benefit that it may provide. Right. So the other part of it is about, what we see as risks, basically from a weaker foreign sentiment, and that is something that could be impacted also. Foreign investors also invest in futures and options, and they are very large players in the futures and options market because they hedge very significantly. Okay, so they are going to get impacted. So some of those are STT impacts are going to be there. Okay, and on the FDI side, okay, there are a lot of measures, and that is also going to create opportunities, including simplification of MR rules, etc. So that is sort of the overview of the budget. So I would say, the budget in the last few years has been a bit of a non-event on the taxation side. Maybe once in 2, 3, 4 years, may find one the lowering of tax slabs, etc. But otherwise, it has been where it was for us. Okay, but the budget in terms of direction of what it gives to the economy, etc. I think that has been very, very good. And so if you see here, this slide captures that how we've been working on our fiscal deficits. And yes, we had come very well to almost like to a low of 3.4%, of the GDP, is what we had in 2019. But then COVID sort of changed the whole equation, and then the spending that had to come in from there, okay, has been has impacted the fiscal deficit. That is despite, I think, India being a lot more prudent in its spending, okay, versus other governments who just gave rollouts and said, okay, here's so many $2,000 for you. Uh, you can just take it home, right? And unfortunately, those also impact, okay, indirectly through inflation and other measures. And you can see that, like today, for example, the US government debt is, skyrocketing out there. So this is a very, very good positive aspect for India, and being very disciplined. Um, the other, and how do they achieve it also, is by, this chart tries to capture how, the spending has been and how the income generation has been from the government. So you'll find that it's interesting. I'll just capture one or two. Like, income tax has brought in, say, 14.6 lakh crores. And, and this is what I'm trying to say, that, how the impact is. Interest payments are 14.1 lakh crores, right? So almost the whole income tax is going away towards interest payments, right? So, which is why maintaining fiscal deficit, etc., within limits is very, very good. Similarly, corporate tax and GST, etc., whatever it gives, you see that salaries and pension of the government, that paid by the government, is almost like 17.2 lakh crores, right? So, so what has been a little good out there in recent times is the government has been trying to spend lesser in areas which are not impacting growth. And so a good part of the spending is on sort of capital expenditure, which is 12.2 lakh crore, is going, towards various capital expenditure projects, which are good for the economy in the long term, right? While borrowings, if you see, has been almost like 16.6 lakh crores. Right? So that's sort of, how the purse strings of the government is. Okay. And but how does it, um, look versus the global scenario? And if you just look at this chart, I mean, you wonder why India's credit rating is so poor. Okay. So we have done fantastically in relation to, a lot of the larger countries. Okay. You'll find that uh, it's also a bit of a declining curve that we are seeing, from 2025 to 2030. Yes, 2019 to 2025 was a spike, triggered by COVID. Okay, but if you see, we are coming back again to better levels, and you will find that countries like China, that were sort of much lower in 2019, today have gone to much higher levels. Okay, so I'm just using it in comparison to give you a feel that how well we've done on managing our government debt. Right, so that's a big one. And coming back to what's the sectoral impact, now I'll just run through a little bit. I'll share these slides later with you all. Okay, but there have been a lot of measures on the infra side, and capex, of the government continues to be strong. I think this time there's focus on city economic regions, and with an objective of developing tier two and tier three cities. Okay, similarly, defense has also got a very good allocation. Okay, and defense capex is again rising 17-18%, which is very high. And to this particular Apex is for supporting modernization and indigenization. Okay, so that's, and India has shown its capabilities, in the recent past on the defense side, and I think this is positive. What's interesting is it's also a good business. Yeah, okay, and we all know that US uses it as a very strong and good business, and I think India, with its capabilities and R&D, and what it has built up in the recent past, I think is making it positive for us also from a business income perspective and export perspective. So IT, there have been some small things around, a safe harbor limit from 300 to 2,000 crores. What it basically means is, if you are within this limit, basically they will accept your transfer pricing, between entities and stuff. So that makes it a lot simpler. So it's more, ease of doing business than anything else out here. And the 20-year tax holiday for foreign companies, offering global cloud services, okay, through India data centers. So there are some, focus areas that have come in, and also you'll find that there's a focus on the semiconductor mission, okay, also as a way to catch up. So that's all of these are, the government is pointing out direction. Electronic manufacturing also has got a reasonable outlay, okay, and with a focus on Make in India, right, is going to be an important part. Okay, the semiconductor mission. 2.0 is area what we already captured there. Okay, so that's something which is also a bit of a push, and the government is also giving, a tax holiday for data center, right? So energy is the other place, where there's been some bit of government focus to reorganize, uh, PFC and REC, uh, Power Finance Corporation and Rural Electrification Corporation, okay, which are both, PSUs and with the whole, it's aimed at enhancing lending efficiency. Okay, so the various measures out there again, to support power sector. And capital markets, yes, this has been the negative, with the increase in STT for the derivative side. So this is going to impact stocks in the capital market side. Okay, now uh, I would not believe it will impact as much because I don't think somebody who was trading in F&O is going to stop because of increase in the STT. So, but yes, this is a bit of a negative for the sector. So broadly, if you look at the number of sectors which have been sort of positively impacted, okay, a lot of them the government didn't do anything, okay, and sort of maintained it sort of neutral. But on the capital market side and stock exchanges and broking businesses, there has been a negative impact. Okay, so coming back to the next section that I'm going to spend time on macros, on earnings, on economics and stuff. Okay, and I thought the first slide I wanted to bring up here is how is earnings, right? Is in Q3 of FY26. Q3 FY26 is basically October, November, December of 25. Okay, which is the last quarter. Now, all results have not come out, as you can see, because this is data as of 29 Jan. Okay, so out of 50 stocks on Nifty 50, 25 declared results, right? And so you'll find that typically, larger companies declare results earlier, and the mid and small cap companies typically, over a period, and the small caps especially are a little late in, declaring their results. But it's very interesting to see that the Nifty stocks, whatever declared results, in almost like earnings YoY growth has been flattish. Okay, so even though uh, the P ratio is low for the Nifty side, and also for the large cap will mean that top 100 stocks instead of 50, okay, of the Nifty. So you'll find there for the large caps the growth has been 6%, okay, and the P ratio has been lower because of at least the growth in earnings. Now, what's interesting is if you go down, the mid caps have grown 20% and small caps have grown actually 33%, okay, for the companies that have declared results. Now we'll have to see once the whole results come out, but this is in line with what we have been telling, and which has been our view that one has been discussing that we expected you know, earnings growth to start coming back to small caps, right? So first, after December 24, when earnings took a hit, you found that, it first came back a little bit to large caps, then sort of mid caps also continued to show earnings growth, but small caps was down. And this is very, very good news for small caps that also earnings growth also has been strong. Okay, so that what that means is that it has ended up reducing the P significantly, even lower than the mid cap, right? So and if you look at 1 year forward, 1 year forward means if you look at the current market and look at the earnings expected EPS of the next year, right, based on this growth, okay, it is a significant reduction further and coming, to very, very attractive levels. So, which is why, it's one of our view that small caps are likely to do very well. In fact, the other chart that is coming out again, showing that small caps are likely to do well, is wherever you've seen a large fall, in the Nifty, subsequently 1 year forward returns is very, very strong. Of course, the first 3 years, it's not there because of the when the index started. That some of the indices started a little later. Okay, but if you see for all the other years, once the index, small cap index, was in uh, started, it has been very, very strong. Other than into FY12, when, of course, there the price correction was only 9% and the 1 year forward was 7. But in most other cases, you'll find that even in 23, when it was a very small fall, the next year was very strong. So this is something that one keeps in mind, that while correction also has been there, it's possibly, a point when we should start looking to invest in small caps. And just to give a fit of how our portfolio stocks have done in terms of earnings growth, you will find that versus the index, there has been a very, very strong, earnings growth for this, portfolio stocks that we hold in these respective, strategies. Okay, so this is something that is, very, very encouraging, and typically in the long term we see that the earnings growth and the growth in stock price typically converge. Okay, so that is something that, makes it interesting, and we think that there is opportunity, for good to see good returns, in the future, if this earnings growth sustains. And coming back again on what again, gives us a little comfort out there is the time of this correction. Okay, it has been a little painful. Normally, corrections are painful when it is longer, right? So 2008, when the fall happened, it started falling in Jan, but by October, it saw a 60% fall within a period of 9 to 10 months. Okay, so that is how quick normally falls are. Okay, and the average fall is between 10 to 24 months. Okay, any correction that one has seen. And this is, we've looked at falls, which the market has fallen more than 10%, at least 30 times. Okay, in the last 4 decades. So this is what data is sort of showing us. And the average decline across all of them has been, say, 27%. Okay, but the recovery period on an average is 14 months. So we've crossed that, and we are coming closer to the extreme point of the period line, where we are sort of almost like 16 months. So we believe, give it another, we think that within another 3 to 4 months we should be the extreme point of what we think the correction can be. Okay, and what are the catalysts for us to sort of create this growth? I think the number of them, right, which are around the horizon, right from the US-India FTA. Interestingly, the EU-India FTA has been, free trade agreement has been already signed. Okay, and you have the RBI, liquidity support, which is there, and you have earnings growth and valuations. Uh, is also, I explained to you that there's already been a correction and valuations have come down. And the last is about, say, government capex, which is likely to trigger growth, right? And so if you see, I'll move through these a little faster. The good part about the India trade deal, and who expected this, that the tariffs for India is going to be lower than most of the rest, right? We've seen a period of pain, but I mean, if and when this happens, I think this is going to be positive for us. And the EU-India trade deal is another one, which, of course, some of these will take time to, operationalize and implement, right? So, but this is something also which, has been very, very positive. You see, the drop in duties and the benefits that, companies could get from the EU region, I think is very, very strong. RBI liquidity, RBI is infusing liquidity repeatedly, and this is also good for the stock market. And if you also see, earnings growth has been reasonably strong, okay, right through for the Nifty 500 companies, and which is also why we continue to maintain a slightly aggressive stance, okay, because we didn't see a drop in earnings, right? And our view was, if there's no drop in earnings, if stock prices drop, then it's normally a intermediate correction. which sort of only a market correction and not linked to sort of earnings fall. If earnings falls, then one typically likes to get cautious because then that is something which will have a sustainable long-term impact. The other one is I spoke about capex push from the government. If you see, there's good allocation increases for defense. Uh, of course, there also has been a reasonable allocation in defense for railways, etc. Okay, you will find that road and transport, again, road infrastructure is also going to see a good increase. Of course, you see in percentage terms, possibly telecom has been one of the largest increases. So multiple sectors which are going to benefit. If you see FPI, what can be the additional catalyst? If SPI is returned to India, we believe at some point when valuations are low, they come back always, and that will sort of have a positive impact. And if you also see rupee stability along with it, and probably that will also trigger rupee stability, right? And the second, catalyst that we think can also come in is the whole global risk of, if there's an easing, and what we mean is there's a higher appetite to take risk. Okay, is when you will find further catalysts there. And in summary, how do you protect your portfolio? I think it's very important right now because at times like these, you may feel okay, there's volatility, it's been down. Even now, even a 2-year SIP may not give you any great return. Okay, and it may be a little frustrating. And investors, some of them come and tell me my FD has done better. Okay, and yes, markets are non-linear and they don't go in a linear way like fixed deposits. Uh, there will be periods when they pause, there will be periods when they fall. But in the long term, if you stay disciplined, okay, then you'll basically see far higher returns than on the debt side. And which is also coming back to the second point of saying, how we're able to look at disciplined investing, okay, looking at quality rather than speculation, okay, and understand your underlying scheme strategies, the stocks that are being invested. I think then you are in a better place. Go for quality. If you are doing that, you may see short-term volatility, but in the long term, you will definitely benefit from higher returns. And it's important to keep relooking at your investments and rebalancing on a periodic basis. In fact, right now when it's closer to the end, as we can see, actually the rebalancing should be towards a higher level of risk. Okay, by and you can take advantage of the corrections to look at investing at this point of time. Now, for many of us, it may be counterintuitive, right? So because you don't feel like investing, right? And and I keep telling people the more, because markets tempt you to do the opposite of what you should be doing. Actually, the more comfortable you are in investing is probably the worst time. Okay, because look at even September of 24, where past returns were crazy good. Right? Even some of our strategies had a 15% alpha over the index. Okay, and at that time you feel much more comfortable to invest. Okay, but that may not be the best time. And similarly, right now, the more uncomfortable you are, okay, it's a better time to invest. As long as you're disciplined and you still look at diversified, funds, not going into any stock or sector and all of that, you manage risk well. Okay, then definitely, it is a good thing to do. So coming back on a few areas, why should I be investing? Basically, a portfolio positioning. Okay, uh, one is in terms of India equity versus global equity. Interestingly, global equity, including emerging markets, has done far better than India in this last 1 year. Okay. However, that's a past. Okay. And in the previous period, if you went back, say, around September, even December, it would have been the opposite. The India outperformed most of the others. Okay. So that's how it is. And so once we are into negative performance, comparative performance, it possibly is a better time to look at India versus global equity. In fact, I'll come back in my next slide and say what are the risks I see, right, especially on global equity. Equity versus precious metals. for a long period of, for some period of time, people kept on saying, silver is like the rock star, right? And the more vertical it went, interestingly, in one of our all seasons, which is a mutual fund of funds portfolio that we had, we booked profits on silver at a little earlier, because we felt that when you see a very vertical rise, you cannot stop loss, and you cannot say, okay, when it falls below this level, I will sell. Okay, which was almost accurate in terms of our expectation. So even though we got out a little early, the fall was so sharp that we could never have got out if we didn't do it in advance. Of course, we also held, gold in some of our portfolios, including, the all seasons portfolio, which I has silver, and there which was a different approach of doing a stop loss. And when gold turned, we exited. Okay, and of course, we bought back gold. We've not yet bought back silver. Okay, so I'm just saying that gold is again, we believe is likely to do well. Silver continues to be risky. Okay, bottom fishing can see, you can see volatility, on commodities, which can be crazy. But gold has the benefit of, being a risk hedge. Okay, by global governments investing in gold. Okay, moving out of US G-SECs and moving money into gold, etc. Apart from just the usage of the precious metal. So that is something that we keep in mind. Large caps versus small caps. I think that even though large cap valuations are cheap, I think small caps are definitely likely to do better because of the earnings growth being strong, and also the correction and valuations coming to attractive levels. Okay. Yes, there may be continued volatility for actually, Feb is a good time where markets normally turn around. Okay. However, that is something that we always like to keep a buffer another 3 months. So I think, even if you look at, if there is one more leg down, then we believe that by June, July, that leg also should complete. Okay, so I'm just trying to say, short term, continue to expect volatility, but you cannot get the exact time when it moves, because just to give you a perspective, when we opened super value aggressive, right, it was a similar period when small caps were really down. Okay, and we took a contrarian you know call, and then we came out with super value aggressive, and that in 4 months gave us 45%, right? So the point is, like I'm saying, of silver, when the turn upwards happen, it's impossible to get it right, and then you may just see very sharp moves, on turnarounds, and you may not be able to get the stocks that you would like to buy. So, gold versus silver, I already discussed while I was talking about equity versus precious metal, and the AI theme, okay, versus consumption. I would think that as we go forward, one needs to be more and more conservative on the AI theme, because any asset which is, really gone up like silver, right? And I don't think silver usage will go down. All of those factors will be there, but wherever there's a very vertical rise, the correction also is very sharp. Okay, so there has been a sustained long-term rise. The AI theme is definitely there to stay, but there will be points where people will ask, okay, how are they making money? Where are the profits? There are a lot of investments going on, where are the profits? Just growth in revenues is not enough. At some point of time, people will come back and ask where are the profits. And the last slide that I would like to capture is on what are the key risks that I see. Right? There's one uh, key risk that I see for the markets, and that is the U.S. markets, especially Nasdaq. Okay, and we think it's not a short term. We think it's a medium term risk, which means even possibly a couple of years from now. Okay, but what could accelerate this? Okay, is U.S. interest rates, and what we call as the yield curve steepening. Okay, when you find that the 10-year GSEC versus the 2-year GSEC of the US, right? When that spread increases, okay, is where one has to be a lot more cautious. And typically that indicates recession, right? In the past, it has repeatedly indicated recession for the US. Okay, so this is something that we will be watching out in looking at it. So from here, I will pause. I tried to cover two topics in this one, so it went a little longer. Okay, but I'll stop here and be happy to take any questions that you may have.